Right, hello everybody. Welcome to today's podcast. My name is Adrian Boothie. I'm the head of trading here at Trend Signal, and I'm here with Jerry Miller.
Good morning.
So Jerry is the CEO, Managing Director of Trend Signal, and our Chief Market Analyst, and really our Lord and Master in all the things that have been going on last week, because there's been an awful lot going on. Jerry's going to talk about it all. A lot to digest in today's markets, as you might have seen, unless you've been living in a cave or something, because the stock markets are now in major correction mode, which is this title for today's podcast. And well, look, Jerry, why don't we get straight into it? What do we know? Tell us about last week.
Well, we know that the markets have been absolutely collapsing. We got lulled into a false sense of security, and we have been making the point in past podcasts that the market had seen too easily through to the resolution of the COVID-19 epidemic. And I think that sort of concerned a lot of analysts, and I think to see the market rebounding after the initial sell-off when we first discovered there was going to be a bit of an impact. It was then last weekend, I think it was in Italy, the number of cases mushroomed, and in South Korea, I mean, they've got something like 2,500-3,000 cases now. That's brought it home that it is not just contained in China, it's spreading. It's in something like 32 countries worldwide now. And that's the worrying thing for the markets.
Well, there was this weird thing sort of Thursday before last week or whatever it was that Apple came out and said actually this might be a bit bigger than we might think, and yet we hit all-time highs on the S&Ps, and yet people were coming out and saying no, it's all priced in, all the risk is priced in. How can that possibly be? We're at all-time highs.
Well, that was a curious thing. That was right. Apple said that they were lowering their guidance for Q1.
Sort of supply chain. Sort of concerns,
basically, because said if you're trying to make an iPhone and you're missing one bit, you don't have an iPhone. So all the components are coming from sort of all different areas and directions. Unless they're all together there at the right time, you don't have an iPhone. And I think the market sort of ignored what Apple said. Well, it didn't ignore what Apple said. Apple's stock price came off, but the market didn't react too much.
Sort of confirmation bias in a way, isn't it? People see what they want to see.
Absolutely.
And they read their own book, they listen to what they think, and not what goes against what they think.
That's
really.
just Apple. It's not going to affect Google, it's not going to affect this, it's not going to affect that. But there we go, that was then and now is now.
Yeah, and now is quite some sell-off, isn't it? As I mentioned earlier, we're actually in a technical correction now, which is, we've discussed this before, that's a 10% move off its highs, although sort of tumbled a bit more than that, really, hasn't it, Jerry?
Yeah, it's an extraordinary move, really. I mean, there's some interesting stats from last week as well, Adrian. We've talked about the VIX before, the fear and greed index. The VIX measures the at-the-money volatility from the Chicago Board of Options Exchange to give its official title, but really it goes up when the markets are fearful and it goes down when the markets are greedy and complacent. Last week, the VIX had its second biggest weekly increase, so that's an increase in 1 week since October the 10th, 2008. That's the sort of epicenter of the Great Financial Depression, or crisis, I should say.
Yeah, I mean, if you look, so I've just brought up Yahoo Finance, which is a site that anyone could look at. That's why I brought it up here. But you can look at the VIX. It's that weird hat symbol. I don't know what it's called. Shift 6.
Yeah.
We'll call it Shift 6. VIX. Have a look at that on Yahoo Finance. And if you go to the max chart here, you can see the extent to which we've been up. I mean, the high last week was what, about 40? Was it 47, 48, something like that?
It peaked around that area.
Which, frankly, it just doesn't really do very often. I mean, that's probably top 2, top 3 rises in the last 30 years.
You when you look at the long-term chart on the VIX, these always look like sort of spikes that come out of nowhere and go back from to nowhere, as it were. But it's actually interesting regarding it. It's certainly the highest level since August, I think, 2015. But it really was expected. We didn't know what was going to cause this movement, and we've always been saying that what it was going to be a surprise. And when someone asked me what's that surprise going to be, I don't know, because it's a surprise. Yeah. But the surprise, when it happens, was always going to cause a lot of angst in the markets, because the rubber band was stretched so far. So when you get that happening, when we got the coronavirus that got renamed COVID-19, that's what's caused this big sell-off. I think there's probably more to come between you and me, but it's going to get more volatile still because the central banks are now involved. So they're starting to stir, and we've started to see a bit of action certainly from the Bank of Italy and the Bank of Japan, and the Federal Reserve is something we'll be looking at as well.
And of course, as the market gets into sort of free fall, it's just going to move faster and faster. And if you consider that, people who are long, they're going to be putting stops below certain lows, they're going to be having long portfolios, and a lot of American investors, they're investing in their pension funds, their IRAs. They start to see it coming down like that. I think, well, I can't have my pension taking more of a hit, so they close out. And if you're closing long trades or buying positions, you're selling, and it just drives selling further. And it takes out support level after support level. It's more and more stop losses that are being triggered that are activating prices moving down and down and down, and it just leads to such an accelerated move lower. Even every time you sort of look to these various support levels, it just went through them like a hot knife through butter, didn't it?
Yeah, it did. I mean, it's interesting what's happened with this COVID-19 epidemic. In the great financial crisis, the news sort of percolated out from the start with Bear Stearns, then you had Lehman Brothers, and then other things happened in early 2009, and we hit the low in sort of March, April 2009. This happened immediately, and as soon as investors and fund managers saw the news, they then extrapolated out, this is going to lead to a global slowdown, if not a global recession, and they immediately start pricing in the worst case scenario. I think this potentially has got more to fall. And if people ask me, do I think it's an overreaction? I think I probably do, but a lot of stuff is not known about this COVID-19. It could mutate, it could cause other problems, but from what I'm hearing, the mortality rate is sort of not much worse than flu. But it's obviously going to be affecting a lot of people, so the actual number of people that could die from this could be significant. But it's just it's a percentage there,
of course, thinking it could bounce or will it go back down lower, it's all a relative thing, isn't it? I mean, we've had a significant rally off that support level at 24773, but in less than 24 hours. But of course, a bit of a dead cat bounce maybe, and maybe it'll carry on a bit more, maybe it'll go down to new lows. The point is, just keep your wrist tight, really, is what I would say. Just keep your trade size low, because with increased volatility, you just got to be aware that the moves are going to be bigger than they would normally be. So keep your trade size smaller than it would normally be to counter that, basically.
And probably another bit of advice is don't listen to Donald Trump too closely, who's basically said, I'd buy the dip. I mean, what we've seen here, Adrian, and you mentioned it, is we've had now a correction. An official correction is where the market moves 10% from the high and comes off. Now, we've obviously seen that. Well, what's interesting with this particular correction, it's one of the fastest corrections that has occurred in the markets. And this is some analysis provided by the Financial Times. And the US indices experienced the fastest correction since the Great Depression from July 1933. I don't think you'll be able to go back that far.
No, but it's just the size of that candlestick, really, isn't it? It's hard to see, because I'm compressing it up, but I mean, it's ridiculous.
And this sell-off that we've seen, because it is a surprise after a very long bull run, it probably is going to be of a greater magnitude. So I'm not surprised to see the sort of the scale of some of these the sell-offs that are occurring. But we did have a bit of positive news. Friday, we had the first signs of the central bank starting to stir. We had not a lot of comments from them during the week, and there were some pretty amazing falls, Adrian, weren't there? And I think some people were thinking, it's going to close on its lows on Friday, but out came Jay Powell, the chairman of the Federal Reserve, the US Central Bank, and he gave the strongest indication yet that the Fed was considering cutting rates. Well, I tell you what, either he's wrong or the market's wrong, because if you're looking at the screen now, Adrian's put up this countdown to the FOMC. It's a look at how the Fed are likely to react to current interest rate moves, and at the moment the forward rates for the Fed funds rates are implying that the Federal Reserve will have to cut rates by 50 basis points, so that's 225 basis points cuts. It's a very aggressive move. That's what's priced in the markets. Will the Fed do that? Interesting. the Fed actually don't even have to wait till the 18th of March. It's possible, if things get really bad, that they could do an intra-meeting cut, whereby they do one without actually scheduling a proper 2-day meeting for the committee. They just do it by phone or whatever, and they announce it. So it could be a bit of a surprise. But I certainly think you've seen a significant shift in sentiment towards what looks like now 1% cut in rates this year. Whereas when we looked at the beginning of the year, I think the likelihood was possibly one cut.
Yeah.
But it's shifted dramatically.
Do you think then, if there is a risk of sort of a meeting like that, a shock meeting if you like, before the 18th, that actually short traders need to be a little bit careful on the stock indices right now? Because obviously if they do cut before the 18th, that's going to be a bit of a surprise, isn't it? You would think that's going to lead to pretty big impact on the market, right?
It would be highly unusual, but let's just say that Friday afternoon we were all looking at it. We were having little bets in the office about where the market would close that night. I felt it was going to close reasonably strong, only because we'd seen a lot of selling. Other people in the office thought it was going to close right down on its lows. But it turned out that just a comment from Jay Powell, who made what he did, he was asked what his view on rates were, and he said he would act as appropriate. And this is there's a lot of Fed speak that people have to interpret, and that's sort of a coded message that he's used in the past, which basically, when he says act as appropriate, he's going to act in accordance with what the market is expecting him to do, because he knows that a rate cut is expected. So he's basically saying he's going to be cutting rates at the next meeting. Intra-meeting, wow, that would be fascinating if they did that.
Do they do that very often?
In unusual circumstances, they did it back in 1994. They did it twice during the, they did it several times during the Great Financial Crisis. Yeah. They didn't wait to meet. They were meeting sort of on Sunday evenings and
They'll be talking all the time, won't they?
Oh, God, yeah.
So,
yeah.
But
it is interesting that, of course, the Fed don't want to add to the angst in the market by meeting as soon as the market falls, because it looks like they're just trying to manipulate the market. But after a week's worth of significant selling, it's odd that you didn't hear any stirrings from any of the central banks until Friday and the weekend. Now we've had three. We've had the Bank of Japan, we've had the Bank of Italy, and the Bank of Italy have acted very interestingly. They've actually targeted industries where they've seen significant fall off in their revenues of more than 25%. So it's quite targeted intervention, which is something that will have to be novel, because I think cutting interest rates on its own is just going to help the markets. I'm not sure it's going to help you and me.
Yeah, absolutely. I mean, it's interesting, the sort of the likes of helping you and me, and this is a weird sort of story in a way, but my mother-in-law is really good friends with someone who runs a Chinese restaurant, and the trade in the Chinese restaurant in lowly Northampton's way down. People are just not going, and and he's the proprietor there. He's got a bit of a cough, but he's chosen to. He never has a day off. He's got a little bit of a cough, so he's chosen not to go in, just in case it really panics everyone. But this is the sort of thing that'll be going on right now.
Yeah, well, it's interesting. We did have questions in one of our workshops last week, where someone said, "Was it safe to go to a Chinese restaurant?" The food doesn't come from China. I wouldn't have thought. It's sort of nonsense, really, but it is having a dramatic effect. What's happening is a collapse in demand. So this is a demand-driven problem, but it's also a supply-driven problem. So we were talking about Apple. We've talked about in the past about Jaguar Land Rover was flying bits for its cars in suitcases from China. It's that sort of it's that bad at the moment. And the problem is, if you haven't got the right components to finished products, as it were, then you haven't got a product. But not just that, not many people are booking flights at this stage. Not many people are going on holiday to Vietnam, Cambodia, Laos, Hong Kong, China, or any long haul flights. The probability of catching a virus whilst commuting through airports where there are lots of people is probably quite high relative to where we are now. But of course it means hotels, airlines, cruise liners, the list goes on and on. Of course, the impact in the global economy is slowing down, is hitting oil, so there's big ramifications. And to suggest that the Federal Reserve or the Bank of England or the European Central Bank could cut rates to cure that problem. We're not travelling, not because interest rates are high,
Yeah.
I'm not travelling. I'm not going to travel because I don't want to get COVID-19.
Yeah. Cut rates so you can save 25 quid on your mortgage a month.
Yeah.
It's not really going to get you out spending, is
But
it?
Adrian, don't get me wrong, they are going to cut rates, and there will be a reaction in the markets, and of course that's what we're interested in. But will it help in the medium to longer term? I'm not sure. I think governments have got to be doing this. This is not a central bank issue. Of course, everyone, when the markets collapse like they do, everyone looks towards the central banks and say, hey, come on, what are you doing? Haven't you seen what's happening? We've had the biggest fall in history. I mean, the Dow fell the most number of points last Thursday that it's ever fallen.
Yeah.
It's quite dramatic. In percentage terms, it's nothing like what I saw in 1987. So, but it's still alarming. And so they will react, and it will cause the market to pause. You have this sort of counter trend rally that we've seen over the last sort of 12 hours, but even that, it then started to fall away, didn't it, an hour or so ago?
Absolutely, yeah.
But I think the market is now probably got a little short-term base in, because it will be aware that the central banks will be coming out and saying something. Whether you and I or anyone else thinks it's going to change anything out in the real world, I doubt it.
That's the point, isn't it? Because now you've got Powell talking about those rate cuts, and suddenly you think, okay, is the market? Are we in a better place than we were on Friday now that he's said that? There is a natural level of support therefore, isn't it?
Markets love cheap money, Adrian. That's another thing, if you are going to buy it, you might buy a little bit more if the Fed have cut your rates, and so you can afford to get a bit more on board. But that's not going to affect you and me. The fact is, we're not going to go anywhere if there's a threat to our families' lives and well-being.
Absolutely. So what about the move then last week? What did it come through as? About 12% on the Dow, wasn't it?
Yeah, it was some big moves. The FTSE was down. Everyone said the FTSE was one that was beaten up the most, but actually looking at the numbers, 823 on the FTSE, down 11.12%. The Dow Jones, 3,583, which is 12.36%. The S&P 500, remember that's 500 stocks, whereas the Dow's only 30, so they don't always go to the same degree as it were, but the S&P, that was 11.5%. The Nasdaq, which is where all the tech stocks tend to reside, 1,009 points, that's 10.5%. But the DAX, see, look at that, the DAX, 1,688 points, down 12.5%. The DAX and the German engineering companies and car manufacturers so exposed to China, and there's going to be no let up now, But there were some interesting moves though, nevertheless, and a lot of the really big falls were centered around the resource stocks. The oil companies got really beaten up with a fall in oil price. A lot of the hospitality stocks, is, going from airlines or travel to Carnival, the cruise line operator, to the hotel groups, all got smashed. But probably quite rightly so. And there will be a number of stocks in there that have been pulled down with the overall industries. Actually,
will fare okay. I mean, you think the utilities, the sort of the defensive stocks there. I mean, people are still going to be spending money on electricity in their homes, aren't they? In fact,
that's right.
Arguably, if they're all on quarantine, we'll be probably spending a bit more.
Yeah, there were some notable outperforms last week. Netflix did rather well.
Yeah, well, there you go, we're all at home watching Netflix.
Absolutely, and 3M, and I thought, 3M, what do they do? And then, of course, I checked it. They manufacture surgical masks, so they're sort of quiz, and I'm not sure.
Well, not antibacterial, alcohol
gel. Yeah, well, the antibac gel. That's right. Yeah.
Antibac's no good, but it's the alcohol gel you need. It's more than 62%.
Okay.
See, that's your solution. If you want to eat Chinese food, you just got to douse it in 62% alcohol, and you'll be fine.
Yeah, a bit of soap and water apparently is.
Yeah, I probably wouldn't wash my food in that though.
What traditional people? Well, yes, okay. Well, I wouldn't wash my food in alcohol gel either, to be fair. Right.
And the currencies, I guess there's been a lot of that sort of risk off, isn't there, last week? So big moves everywhere.
Yeah, a lot of people wondering what's going on, but we've really touched on the reason. Obviously, we've just been discussing interest rate.
But which are the most affected currencies like this? I mean, obviously, resource stock, resource and economies that have a strong affiliation with China. So New Zealand, Australia.
Yeah, they get mashed. Yeah. The Aussie dollar, the Canadian dollar, and the New Zealand dollar, they all got hit pretty bad. If you put up Aussie USD, have a quick look at that.
Especially given where it's come from already.
Yeah.
I mean, it's.
I mean, when you compress these charts up, it really does look like it's fallen off the edge of a cliff. And what's interesting now is that there's a high chance that we're going to have a cut by the Reserve Bank of Australia this week as well. We'll get onto that in a second if we've got time, but it's likely that they're going to be cutting rates midweek. So that's got further to move, possibly.
So what is the correlation here? Let's just be clear. So Aussie dollar took a hit last week. New Zealand dollar took a hit last week. Canadian dollar, obviously very resource driven. But strength-wise, you're really looking at the yen?
The yen and the euro. Yeah.
Which is curious with the yen, given that
they've had an appalling set of data.
Yeah.
I mean, when they raised the consumption tax, their GDP in Q4 last year literally fell off the edge of a cliff. But it still goes to show that in extreme circumstances, people have got no option but to pile into the safe haven that was, and it's been less of a safe haven. But if you put up the dollar yen chart on the bottom there, so that's just mad, you know.
And remember, when you're looking at the chart, you say, hang on a second, I mean, that's gone down. You know, what do you mean? You're saying that yen's gone up? Yes, exactly, because it's the inverse.
Yeah, that's the number of yen to the dollar.
So the dollar has gone down against the rising
yes,
yen.
But fewer yen to the dollar means the yen strengthening. So that's really the dollar falling against the yen, that graph. And there's no other reason apart from safe haven buying. Whereas if you put up your euro, obviously that's really a proxy for the dollar index. It's got about 56% of the weighting of the dollar index, and the reason why the dollar has fallen against the euro is because of expectation for a cut in interest rates.
Yeah. And
you might say, well, hang on a second, why aren't the eurozone cutting rates? They can't. They're at record lows.
Yeah.
The sort of refi rate, I think, is at 0, but the actual rate that banks can lend at to the ECB is something like -0.5%.
So can you just explain just why, if the US, they're more likely to cut rates now, almost very likely, why would that lead to the dollar falling?
Okay, so if you've got money in dollars, it'll pay you a dollar interest rate. If they cut that interest rate, you'll be less inclined to keep that money in dollars. It's as simple as that. So it's called the interest rate differential. So you're more likely. So for anyone who's got money in euro who would be tempted to swap it out and invest in dollars, there's less of a reason to do that, especially if interest rates come up 1%.
So people are more likely to hold it in euros or switch it into euros for the risk or whatever it may be.
There's also another thing that's been affecting this, because the euro has been used as a funding currency. I can explain that by saying, with record low interest rates, it's very cheap to borrow euros. So if you want to borrow a currency, a stable currency, borrow euros, and they'll charge you the absolute end of nothing. Yeah?
Yeah.
You then take those euros, sell them, buy dollars, buy Swiss, buy anything, buy sterling, and invest in a market that's giving you a lot better return.
Yeah.
But what's happening now with the market imploding, obviously a lot of these trades are being reversed. So a lot of hedge funds and groups, trading groups that have carried out that type of trade are now reversing it. They're closing out those investments, getting the proceeds, the fact that they probably lost, switching them back into euros, which causes the euro to rally. So they're selling dollars, buying euros to close that.
And of course, we're talking about people with mighty big positions. So that's hence it's just going to create more movement. And when it's a pretty scary time or fearful time like it is, you end up with a slightly thinner market in terms of market depth, orders that are in the market there. So it takes, it does scythe through those prices more quickly.
You're right.
Definitely.
People tend to be all going one way. So whilst we only had sellers in the euro in the first sort of 3 weeks in February, there are only buyers out there now because of what's happening in the marketplace.
Right. Okay. Anything else to add, Jerry?
Well, not on currencies. I just think it depends what the Fed say in upcoming speeches and stuff like that. But it really just depends on how these markets react. But I don't think it's over. Looking at what's happening in the markets at the moment, my suspicions are that anyone will sell into any sort of rally like we had this morning, but they will be a bit nervous about what could happen in on the downside as well in in terms of central bank sort of announcements, etc.
So what do you recommend for traders? I mean, one of the problems that so many traders have faced in their time is they look at a market that's just, coming off as aggressively as it has, and they're thinking, oh, that must be a bit of a bargain down here. What should traders be doing now, do you think?
Well, there's no such thing as buying something because it's cheap.
Yeah, it's such a relative term, isn't it?
Everything is cheap if it comes off and expensive if it goes up, relative to the previous day or week or month or whatever.
Yeah.
But you just got to be incredibly careful. Because the markets have departed so far from where they were, it means that it's just highly unusual and anything could happen. The markets could rebound so far and not really give us a signal. They could carry on coming off and we wouldn't be able to trade either. But in a way, that's self-preservation.
Yeah.
That's telling us not to trade.
Yeah.
The only thing that is easier to consider at this stage is obviously short-term trading.
Yeah. Well, there's some significant moves on things like the short-term charts. I mean, I was looking on, I think it was Friday, the average true range on the Dow 2-minute chart was about 50-60 points or something. So it was bigger than the normal Euro daily true range.
In 2 minutes.
On a 2-minute chart on the Dow. But of course that means there's a lot more sort of opportunity for short-term traders. So, but probably smaller stake than you would do ordinarily. The one thing that I would suggest is really have a mind of what the longer term trend of the market is. When you're seeing the moves like this, it is so tempting, and we've all been there. We look at a market coming off and think, oh God, it can't keep coming off, can it? But of course it can. And the danger is that people look at a chart like we're showing here on the Dow, or if you're listening to the podcast, you might want to bring the Dow chart up for the last couple of weeks. You'd have got crucified if you were trying to buy this.
But what you've got to remember, Adrian, is that if you scrunch the chart up again, it hasn't gone back that far.
It's remarkable, actually, isn't it?
Look at the FTSE. The FTSE, we're back a year or more, 2 years. Yeah. But the Dow, we were here in sort of October time. Well, actually, we've gone through that now, but June time. It's
June's
not that far away. A market I think actually is probably offering better value is probably the UK market.
Yeah, we're significantly lower than June last year, aren't we? I mean that's so you can see June. So FTSE, so we're sort of 8% probably lower than June last year, whereas we're about June's levels on the Dow. So we've taken out December 2018. Interesting level there, but
when there's uncertainty, and we've got the start of these trade talks this week, and remember the other thing that's causing a bit of angst is obviously the weakness in sterling. But in a way, the weakness in sterling could help the FTSE, but not whilst all the other markets are collapsing about their ears. That's for sure.
There's kind of a bigger picture going on, really.
Yeah, that's right.
So normally we'd do a feature in here where we'd sort of talk about the things to be trading, the things to be looking out for. My suggestion really is just to calm down a little bit this week. There's plenty of opportunities, but just consider the trade size that you're placing. The volatility is higher. That means stop losses are likely to be considerably bigger than normal, and you've got to factor that into your trade sizing. So if your stops are twice as big as they are normally because of the volatility, you've got to be looking to half your trade size. And just don't be trying to rush into the market just because you think this is a once in a lifetime opportunity. It isn't. These black swan events, if you want to call it that, they're not where people are sort of really making their money. It's from the day to day, and that's what you need to be focusing on, is normal market behaviour, not just sort of going in all guns blazing. Because we've seen too many times where people do that and they just lose money.
Yes, what you've got to remember is this isn't a lot of speculators shorting the market. This is the trade. This is funds. This is long-term investors who are having to insure their portfolio against further losses. And you talked about it earlier on. There's a bit of a snowball effect here where falls beget more falls and beget more falls, and it sort of turns into a bit of a spiral, really. Yeah. And that's something that eventually runs out of steam. Like when the Federal Reserve sort of makes a comment, etc., it sort of stops it in its tracks. Yeah. And it gives time for people just to consider things more carefully. But certainly I think caution is the watchword.
Yeah. Okay, so for this coming week then, I mean, it may all be totally outdone by any interest rate changes that might come, or any other central bank intervention, but what are the main events to look out for this week? Let's put our normal hat on, shall we?
I'm going to put my normal hat on, but I'm also going to say is that COVID-19, if the number of cases mushrooms in the United States this week, it will hit the markets. So no matter what data comes out, no matter what someone says here, that will also dominate what's going on. And that's what dominated it last week. Suddenly, it wasn't a Chinese issue, it was a global issue. And I just think in the US, they've got a few cases, but nothing like as many as the likes of Italy, South Korea, etc. And you think with such an open economy that they would have a lot more cases. So that is a risk. But anyway, yeah, so this week, we've already had something called the Cakes in Manufacturing PMI Index. This is the private sort of sector one that's done and not the state sector one. If you actually go back to the Saturday last week, which means going to February, click on February and the last one there. If you look on Saturday, we got the state Chinese numbers.
Yeah.
Just extraordinary.
Yeah, they're horrific. I mean, look at the non-manufacturing one.
I mean, that's
so
services.
50. So 50 is the status quo, if you like.
Yeah, that means no expansion, no contraction. Above 50 expanding, below 50 contracting. 29.6. Yeah. I've never seen a number at 35.7 looking at the manufacturing.
Presumably that's a 40% fall, isn't it?
Yeah. Well, this is the reason.
What that means?
It's just huge. It means no one's doing anything effectively. I've just never seen any numbers from any country that low, and that's the reason why the markets last night. I was watching them at sort of 11 o'clock when they opened. They fell significantly.
Yeah.
But then they rebounded because the Bank of Japan injected liquidity.
Yeah.
And that's what saved the markets. But otherwise, those numbers are signalling a global recession. That's catastrophic.
Yeah.
And that's what the central banks and governments as well will be fighting.
And for us, I suppose, it just depends on how much of that fall last week is factoring that global recession in. You know, isn't it really?
Yeah. Well,
that's a tough one to judge.
Yeah, it is. But markets are very quick to try and discount as much as possible, where the effects may not be felt will be felt over the next 9 months, as it were. But anyway, so that Cakes in one is a separate one that's done by a private company, but you can see they were predicting 46.1, came in at 40.3.
Yeah.
It tells the same picture, although not as extreme as the state-run organisations, but just goes to show you. Other than that, then this afternoon we've got the manufacturing PMI. Again, these numbers unfortunately are not going to be that relevant after all the equity collapses last week. So I don't think the markets are going to react off them, Adrian.
So the big ones to really look at is going to be the RBA statement, the Bank of Canada rate statement Wednesday afternoon.
Well, that's not said, but I'll explain why. So certainly in Australia, this time last week there was going to be no cut.
Yeah.
Now, because of what's happened, the market has priced in a quarter-point cut, so from 0.75 to 0.50, and it will be the rate statement that we'll be interested to read when that's published. But we'll find out about that when we wake up tomorrow morning, Adrian, and we'll see the effects on the Aussie pairs as well. But for Canada, jumping to Wednesday, the Canadians tend to follow the US. Now you might think, well, aren't they cutting? Well, the US aren't cutting. If the US did a surprise cut, maybe the Bank of Canada would do a surprise cut. But I suspect they're going to wait until the 18th of March when the Federal Reserve slash their rates by 50 basis points or 0.5%. So that's the reason why it says 1.75. I may be wrong, and in fact, the Forex factor may be wrong as well, but that's what the prediction is, 1.75% staying there for now.
OPEC, I mean, obviously oil's been quite topical of late. Is that going to be worth
There's
keeping on the radar?
Yeah, there's a lot of talk. This is their meeting in Vienna where they're headquartered. The cartel love to protect their own revenues, so they're petrified about the price falling any further. The price of oil has just collapsed in line with equities. There's going to be a global slowdown. The demand for oil will shrink in line with that. And these things are all sort of finely balanced, really. And if you're going to take away quite a lot of demand, then OPEC's view is they're going to have to do something about supply. So they're talking about cutting 1 million barrels per day, which is quite significant.
Yeah.
But as always, they love fighting their own corner, and getting them to agree on that might be quite interesting.
Yeah, absolutely. I mean, ordinarily, the old non-farm payroll change would be probably the most important item of the week, but it's probably something that's not even on the calendar that will end up being so. But otherwise,
it is something that's
still important.
Yeah, it's still important. It's normally, along with interest rate moves, it's probably the most important data release of the month, and it always happens in the first Friday of the new month. So Friday the 6th was the first month of this month. 185 new jobs. We had a big number last month, and I always think that you always get a bit of an outlier gets corrected the following month, and I wouldn't be surprised if that number's in fact even lower than 185,000, which is still above the average for the last sort of 12 months.
So we'll look out for the revisions on the 225.
Yeah, that's possible as well, but 3.5% unemployment rate, multi-decade lows. So I just think this data, in light of what's going on with COVID-19 and the possible impending pandemic classification, then we've got other things to think about, really.
Yeah, I think notwithstanding, if we're focusing a little bit more on some of the shorter term moves, because of that volatility, one thing non-farm payroll always does, whether you're an economist or not, is create movement in the market.
Yeah.
We're not trading it at 125 and sort of punting over the number or anything like that. But what it does, it creates movement that you can then trade after the event, and that's the much better way to play this.
Really. It creates that flux exactly there.
Yeah. Well, I think that's pretty much it, Jerry. Any Jerry Springer final thoughts?
Oh no, not really. Gold was an interesting one last week. We've been asked several times about gold.
Yeah,
Gold's
that got hammered, didn't it?
It got hold, and everyone says, "Well, hang on a second. I thought gold as a safe haven. I thought people buy gold in this environment." Do you know what? You're right. But when everyone is selling, you've got macro funds selling all their positions or trying to hedge their positions. When they look at a position that's making them loads of money, they're particularly nervous. And when the sell-off started, anyone with a profitable trade on board was just selling it.
Yeah.
And at one stage, it was $80 down on the day.
Yeah, that's unreal.
I mean, if you have, up by the stairs, down by the elevator, that is a classic one. And there is no real reason for it to stay down there, apart from the fact that people are just, investors and funds are liquidating profitable positions to offset some of their massive losses elsewhere.
Fascinating.
Yeah, there we go.
Okay, that's pretty much it, really. So why don't you quickly just finish off? I don't think we have time really for the defining trading stuff today. I think there's more interesting stuff to talk about. But I'll finish off with look, if you want to learn a bit more about Trend Signal and the strategies that we use here at Trend Signal, then why don't you tune into one of our live upcoming events. We've got 3 events on this week where we'll be teaching the 3 simple rules for identifying high probability turning points in the market, and we can apply that to FX, indices and commodities. If you want to register your free place, then please do the following. Open up a web browser and go to bit.ly, so bit.ly/learnts, so bit.ly/learnts. And if you would like to actually tune into more of these podcast events, then just search for the Trend Signal podcast to listen to us on iTunes, listen to us on SoundCloud and Spotify, or you can watch and listen on YouTube as well, or our lowly old website, which is trend-signal.com/trendsignal-blog. All the best, guys. Have a great week's trading. Keep your risks nice and tight. Cut that trade size according to the volatility, and we'll see you again next time. All the best, and bye-bye for now.
Bye now.